Hi investing friends, Joe here. Today I'm going to talk to you about how to safely catch the proverbial falling knife. And I say safely with an asterisk because as the name indicates, catching a falling knife is inherently very dangerous, right? There's a reason it's called that, and it's really easy to get your hand cut, so to speak. But there are some ways, techniques we can use to minimize disaster and maximize success. So I'd like to look at the Tesla chart and give you an example of how to safely, or at least more successfully, catch the proverbial falling knife. Before I do this, let me just say that this is just for entertainment. It is not financial advice whatsoever. And please realize that anytime you try to catch the falling knife, the odds are great that it is going to be unsuccessful. So let's look at the Tesla chart and talk about this. Then I made a 6-slide PowerPoint on some general guidelines for techniques for how to do this, which we'll look at the end of the video. So the first thing we do is we look for a really obvious support line. You want it to be as obvious as possible. And here's the 5-year Tesla chart. And one thing that you may know, or at least you should know, if you don't, about a breakout is roughly 50% of the time a breakout will pull back to its initial breakout point, the top of the cup, so to speak, in a cup. And the odds increase during a bear market or neutral market, sideways trending market. And the odds of a big pullback like that decrease during a very strong bull market. So here, when we look at the Tesla 5-year chart, we see this very obvious support line at the top of the cup. So when Tesla started crashing down, as Elon announced that he would be selling off shares, it was really obvious to retail investors and institutions alike that there is strong support at the top of this cup. So that is where we could consider catching the falling knife. So here we are on the 1-year chart now, and technically the top of the cup would be about 875, but there's a real psychological round number effect where retail investors tell themselves, I'm going to buy when it hits a certain point. So it was pretty easy to predict that investors would start getting in at 900. So you just set a buy limit at 900, right? No. If only it were that easy. That's what a lot of people do, and that's how people get burned. What we want to do is not get the very best price, but rather get in when we are more, let's see. Sorry, I was trying to figure out how to phrase that. We don't want to get in at the very lowest price. What we want to do is get in at the price where most of the risk is gone. So what we do is wait for a confirmation candle, a confirmation up candle. So now, if we zoom in on this chart further, okay, here's the last few months of the Tesla chart. Here's Tesla falling down, and here it hits 900. And instead of buying at 900 or setting a buy limit at 900, what we do is we wait for it to bounce off of resistance, and we want to see it bounce like a tennis ball. We don't want to see it splat like an egg or sit and squat, but we want to see it bounce hard like a tennis ball and close at the top of its daily range, or at least within the top third of its daily range. And if you look, that's exactly what Tesla did here. So then what we want to do is we try to buy at near the close of that day. Now this was, the high of this day was $939.50, $40 off of the low. So we are sacrificing $40 worth of share price, but now we are fairly sure, much more certain, that a true rebound is going to happen. And as you can see, the next day it gapped up strong. And that's why when you determine that the stock has indeed bounced strongly off of the support line, that's why you really want to try to get in near market close of that day instead of waiting and buying at the market open of the following day. Let me show you one more example. This is Costco, and we are looking here at the end of 2020, beginning of 2021. All of the growth stocks sold off indiscriminately, and Costco fell with it. And we know that Costco is a strong company, and we know that it was going to rebound quickly. So it was just a matter of figuring out what price to get in. So what we could see here is a very obvious base, right? And the top of the base is about 310. So when it started rolling over, it makes sense that it would probably pull back all the way down to the top of its previous base. And when it did, we need to be ready to buy, right, and catch the proverbial falling knife. But we don't just buy it blindly, as I said. So what we would do is we would wait for a confirmation up candle. And here you see after bouncing off 310 twice, we had a couple down days, and you don't want to buy on those days. But then on the third day, it closed strongly to the upside near the top third of its range. And so at the end of this day, this would have been the day to buy, right? And as we can see, in this instance, it's worked spectacularly well, and it hasn't revisited that low, and now it is, nearly double that price. If only it were that easy. As I said earlier, catching a falling knife is inherently risky. Let me show you 6 PowerPoint slides with some rules to help you catch a falling knife more successfully. All right, so in general, we don't want to catch falling knives at all. We want to buy stocks near all-time highs coming out of flat and shallow bases. You're long-term going to have a much higher rate of success in having successful trades when you do this. However, when you are buying, trying to catch a falling knife, the first thing you want to do is look at the general market. You want the general market to be in an uptrend or sliding sideways ideally. And if it is pulling back, you want to see a gentle pullback. You absolutely do not want to try to catch a falling knife during a dramatically falling market. When the market as a whole is falling dramatically, support lines get blown up and stocks will hit them and fall through them immediately, or bounce for a day or two and then continue falling. You want to make sure that the company is doing well currently, and the fundamentals are going to get even better in the future, and most importantly that there are some bullish news catalysts coming ahead that are going to buoy the share price. Then, like I said, instead of just blindly buying when it hits a certain share price, or setting a buy limit order to trigger at a certain share price, you wait for a bouncing confirmation candle, and you want that candle to close near the upper third of its daily range, preferably at or very close to the top of its daily range. And when you get this confirmation candle, when the price action bounces like a tennis ball, then you want to buy near the market close, within 5 or 10 minutes of the market close, instead of placing a market order for the next day, because oftentimes it will gap up the next day, as I showed with the Tesla chart. Let's see. Now, whenever we buy a stock, we set a sell stop. So as soon as you buy it, set a sell stop for 10% or less beneath your purchase price, or just below the low of the confirmation candle. So in Tesla's case, if you bought on December 21st, the low was 886.12. So you would set your sell stop at, say, 886 or 885.99, something like that. And I just measured out the percentage. If you did that, your percentage risk would only be about -6%. And lastly, because you have a tight stop and because catching a falling knife is inherently difficult, expect to get stopped out often. Do all of the things I said above and still expect to get stopped out, probably at least 40% of the time. But you will still be successful if you do these things because you'll get stopped out for 5 or 10% half the time, and you'll make good gains the other half of the time. So your reward is greater than your risk. Well, that's all I have for you today. Let me know what you thought about my ideas on catching a falling knife, and if you've had any success in doing so out there in the real world. And if you got something out of this, please consider liking and subscribing and or pressing the notifications button. Take care, everybody.